Today, I'm going to go through 5 stocks you do not want in your portfolio right now. Timing your entry when it comes to buying a stock plays a crucial role in the potential outcome of the stock. As investors, we understand that there are no guarantees, just probabilities. So we need to ensure that every position we take has the odds in our favor for a positive outcome. This means you must have what is called an edge. An edge is establishing environments where you have more chance of making profit than a loss. In today's recording, we will look at 5 heavily talked about stocks on our media channels that currently have no edge and so have more chance of losing you money than making you money. And at the end of this video, I will share an obscure stock that is outperforming all of them. If this video helps you to up your investment game, do like, subscribe and hit the bell notification. And don't be greedy, guys. Do share it with those who need to watch this. We have helped hundreds of private investors over the past 10 plus years learn to profit from trends in the markets through our simple to learn methodology. I also write for a number of publications, including benzinga.com, and I'm regularly invited to guest speak on how everyday people can skyrocket their stock's performance, focusing on the next 3 to 5 years. So in investing, there is a saying: if you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. An edge, once again, is establishing environments where you have more chance of making profit than a loss. The simplest way to establish an edge for us as busy everyday people is using technical analysis, which is just a flashy term for using charts to make your investment decisions. You can use the Warren Buffett approach, which is to use fundamental analysis, but it is far more complicated to learn and execute and is also very time consuming. Most people struggle to have a proper lunch break in the day, let alone the time to do the right kind of fundamental analysis of a stock. Technical analysis, on the other hand, is a simple to learn and execute and has a proven history of performance. Here is an interesting fact for you. Warren Buffett, who uses fundamental analysis, averages 20% a year. Richard Dennis, on the other hand, who used technical analysis and was a trend follower like we are here at Sublime Trading, averaged over 100% annually. So what makes more sense to use, technical analysis or fundamental analysis? Time is short and ticking away. Technical analysis and trend following combined with spread betting and CFD accounts, which I covered in yesterday's video, is a formidable combination that will drastically improve your portfolio's performance. So let's switch over to the charts and do an in-depth analysis of 5 heavily talked about stocks that currently display no edge and an obscure stock that is outperforming all of them. So here is my 3-screen setup. I have the monthly in the top left, the weekly time frame in the top right, and the daily time frame down here across the bottom. Now I like to look at the larger time frames or the higher time frames because it gives me a much clearer picture of what price action is actually doing. When you start going down to the lower time frames, that's 5-minute time frames, 1-hour time frames, etc., ultimately intraday time frames, that's when you get into day trading territory and ultimately where people lose a lot of money. By looking at the higher time frames, this is where you get into investing and trend following, and where you do far less work for far more profit. Now, ultimately, there is an element of patience involved with this, waiting for the right setup, waiting for your edge to present itself, and that's where a lot of people fall short in the hope of quick riches. We want to look away from that approach. Always stay true to the principles of good investing, which is to think long term. So the higher time frames really help with that. Once again, the monthly in the top left, the weekly in the top right, and the daily time frame down here across the bottom. The first stock we will look at is Apple. Now I'm going to start with the monthly time frame. If you look at these markers here, we've got the high of last year and the low of last year. When price has a bullish bias, that is when it's looking to push higher and return a profit. For long investors, you want to see price trading above the high of last year. If you're looking to short the market, you want to see price trading below the low of last year. This is where patience comes in, and this is where establishing an edge comes in. If you look at price action at the moment, we can see that since the all-time high, which is from January of this year, Apple has fallen by around 25% and is currently trading in between these two levels, which is the high and the low of last year. If you move across to the weekly time frame, we can see, and if I just open that up, we can see that price is still above the 200 moving average, which is positive. The 200 moving average gives the average of price over 200 weeks. What you want to see is price trading above the average for a bull market and below the average for a bear market. Price currently is trading above the 200 moving average, but it's below the 50 simple moving average. It's between these two averages, and that's why on the weekly time frame there currently is no edge. For price to have a bullish bias, we want to see price trading above both moving averages, and a bearish bias, we want to see price trading below both moving averages. Currently it's between the 50 and the 200 simple moving average. Our trend filter is also red, confirming that it is currently weakening. Now, if you come to the daily time frame, the daily time frame paints a very different picture. It's trading below the 200 moving average, the 50 simple moving average, and the 20 simple moving average. So the daily time frame is confirming potential further weakness. So what we have here across the monthly, weekly, and the daily time frame is a lack of alignment. Alignment is when all three time frames are pointing in the same direction. They're either all bullish or all bearish. So if they're all bullish, we can go long. If they're all bearish, we can go short. If they have a mixture of bullish and bearish factors, or certain elements are suggesting that price is in a sideways market, then that is an environment, or that is a stock or an asset that has absolutely no edge. So Apple currently displays no edge. I'm going to just recap that one more time. On the monthly time frame, it's trading between the high and the low of last year. On the weekly time frame, it's trading between the two moving averages. That's the 50 simple moving average, which is the orange line, and the 200 simple moving average, which is the black line. And if you come down to the daily time frame, it's trading below all three moving averages. So on the monthly time frame, it's more of a neutral bias because it's between the moving average, it's between the high and the low of last year. On the weekly time frame, it's bullish because it's above the 200 moving average, but it's bearish because it's below the 50 simple moving average. And on the daily, it's below all three moving averages, confirming there's bearishness. So what we have, as already mentioned, is no alignment. We want all three time frames to be either bullish or all three time frames to be bearish. You will notice that the other four stocks that we go through will all have a similar setup. Next stock we look at is Google. Notice Google is currently trading between the high and the low of last year. It has also declined since the start of the year. It has also declined by 26%. On the weekly time frame, if I just open that up, you can see that it's above the 200 moving average, but below the 50 simple moving average. The trend filter is red, so it's between the moving averages, telling us that there is no bias at the moment. And on the daily time frame, price is below the 200 moving average, the 50 simple moving average. It's currently trading around the 20 simple moving average. So it's far more bearish on the daily time frame than it is bullish. Hence why, again, looking across all three time frames, there is no edge. And Google is not a stock you want to be buying into right now. Next up is Facebook, now going as Meta. Now, this is interesting. Facebook has really taken a hit. And you can see that compared to Apple and Google, Facebook is actually trading below the low of last year. This stock has fallen around 58-59% since its high, which was in September of last year. If we move across to the weekly time frame, we can see that price is trading below the 200 moving average. It's trading below the 50 simple moving average. And if we come down to the daily time frame, we can see that price is trading below all three moving averages. So if anything, Facebook is a stock that you may potentially want to short and take advantage of this downside movement. It's certainly not a stock that you want to be buying into right now. All factors suggest that Facebook is only looking to weaken further. Now, of course, price could find support and it could bounce to the upside. But remember, guys, we're playing on probabilities, not certainties. And the way Facebook is set up right now, the way Meta rather is set up right now, it is suggesting that potential further weakness is on the cards. So if you buy into Facebook right now, you could see Facebook drop against you and stay at these very low prices, and may take a very, very long time before it reverses and heads back to its all-time high. So again, Facebook or Meta, it's not a stock you want in your portfolio, not right now. If you want to short it, potentially, certainly not one that you want to buy into. And of course, we have Tesla. Now let's start with Tesla. Tesla is trading inside the high and the low of last year. Tesla has fallen around 43% since its high, which was in November of last year. On the weekly time frame, it's trading between the two moving averages. That's the 50 simple moving average and the 200 simple moving average. And on the daily time frame, it's trading below the 200 and the 50 simple moving averages, and it's trading around the 20 simple moving average. So again, Tesla is a stock that has a mixture of bullish and bearish factors, so not a stock that is displaying a clear edge, and so one that you want to steer very clear of if you're looking to buy into Tesla. You want to wait for a recovery in the market before looking to buy these stocks. You want to see price confirm bullishness before you jump into them. That's really where the patience comes in. And the final stock we will look at out of these 5 stocks is Twitter. Of course, Twitter has been all over our media channels in recent weeks because of Elon Musk, but Twitter itself is just a very poorly performing stock. First of all, it's just been going sideways. If you look at where it is right now, it's trading back around its IPO price. So it's gone absolutely nowhere since 2013. So a stock that just hasn't got a history of performance, and that in itself is a reason why you don't want to buy into Twitter. On the weekly, it's below both moving averages, and on the daily, it's below all moving averages. So again, it's not a stock you want to buy into. The primary reason why you do not want to buy Twitter is that it lacks a history of performance. If a stock has performed well in the past, then it's very likely to perform well in the future. Twitter has no history of performance. Okay, so let's switch over to a stock that is outperforming all of these, and a stock that no doubt you probably have not heard of, and that is McKesson Corporation, ticker symbol MCK. If you look at McKesson Corporation, in the time that the 5 stocks that we've looked at have all plummeted, this has gone from strength to strength. If we take it from the start of the year, or even from December last year, if you look at it from this point here, price at its high point moved 55%. There's a bit of a correction in the market at the moment. That's expected. It's around 41%. So in the time that many of these stocks have fallen over 25-30%, this stock has continued to perform well. Now, if we move across to the weekly time frame, look at where price action is in relation to the moving averages. The 200 and the 50 simple moving average, price is trading above both moving averages, and on the daily time frame, price is above the 200 moving average. It's currently below both these moving averages, which is the 50 and the 20 simple moving average, but that's expected. After every trend, you can see how well it performed. There has to be some kind of correction or consolidation in the market, and that's what we're currently seeing. After every move, the market consolidates. What we're waiting for now is the next breakout above this high, and once this high point is taken out, we can then look to start buying McKesson. McKesson is already in our portfolio, and we will look to add further positions. If the market continues to weaken, then we will cut out of our positions and lock in whatever profit we've accumulated. But for now, this is simply holding. It's creating a base. Next breakout is when we look to buy further positions, also known as compounding. So there you have it, guys. Don't forget to like, subscribe, hit the bell notification. I hope that really helped you guys to understand how you want to establish an edge whenever you're looking to buy into a stock. And if an edge is not being presented, stand aside, regardless of what the stock name is. You don't want to get caught up in brand names. You want to get caught up in what the chart is telling us. And if the chart is displaying an edge, you can buy or even short the asset. If it isn't, stand aside. Look at stocks that are displaying an edge. And that's all part and parcel of putting a portfolio together and then rebalancing it when the time is right. So where do you go from here, guys? Well, go down to the link in the description below. The link will open up into this scorecard. Are you ready to skyrocket your stock performance? Take the scorecard. It will take you less than 2 minutes to complete. At the end of the scorecard, you get a detailed report on your performance. And not only that, guys, we will give you 30 days free access to the Hot Stocks Vault, where you will get the 10 best performing stocks every single week, as well as a host of other goodies. If you liked the 3-screen setup that I just did my analysis on, you also get access to that as part of the Hot Stocks Vault. See you in the next recording.